DeFi Explained, Decentralized Finance Animated, Everything You Need to Know. Hello and welcome back to Metaverse. For today's video, we are going to be talking about DeFi, Explained, Everything You Need to Know. Let's get started. What is DeFi? It refers to decentralized finance. We have always had centralized money in the past. It is the location where a central authority oversees the movement of money. It is under the sway of the government and banks. They don't actually do as they claim. However, they have the ability to ban you from borrowing it and print more of it if they so choose. If they prefer that you don't. Even opening a bank account is something they can prevent. They may take your money at any time if they chose to. You couldn't really object because they have your money and might change it. Decentralized finance is an alternative where banks are not present. Rather, there are bits of code that functions and behave like a bank. They don't require you to trust them because they are essentially just a piece of code running a program, which means you could look through it and make sure it isn't going to swindle you if you wanted to. In addition to being censorship resistant, they are also far less expensive than conventional centralized finance. Three main things. Decentralized finance is based mostly on three elements: blockchain technology, smart contracts, and cryptography. If you are unaware of what these are, you are familiar with blockchain technology, cryptography, and how smart contracts operate. Understanding the link between decentralized and centralized finance is necessary, and that is digital currency that is correlated with a physical item. 5 pillars of decentralized finance. Stable coins. Stable coins include, for instance, DAI Tether and USD coin. This is due to the fact that their pricing is determined by the US dollar. Consider it this way. A new dollar coin is produced when you buy one for $1, and a dollar coin is burnt when you withdraw one. Therefore, the value of the coin is always $1. Now, the idea behind this is to have a secure method of buying and selling specific coins without actually buying and selling them. We can simply trade them in its place. Let's use the purchase of one Ethereum at a price of $500 as an illustration of why this might be advantageous. It's now worth $1,000 and you want to sell because you believe that the price is too high. You want to keep the money. You might sell your Ethereum on a controlled exchange like Coinbase or Binance if stable cryptocurrencies are not available, and in exchange for that, they will pay you some US money. Naturally, they will take a portion of that transaction because they want to get paid and will accept the price. Additionally, you must pay tax on any profits you make from trading or selling, according to the IRS. You won't really be able to avoid it because Coinbase and Gemini will leak the fact that you made it. Waiting for them to be given to your bank via Coinbase or Binance would be the next step. Then take them out of your bank because you truly don't want the bank to have control over your finances. After a month, Ethereum falls to $250. Then you decide to purchase more. So you transfer your $1,000 back into Coinbase. You then have to wait a few days for the transaction to settle and hold them after purchasing Ethereum. So you decide to sell, and when the price of Ethereum increases to $500, therefore you sell them at your main exchange. You pay the fee and wait a couple couple of more days for the money to appear in your bank account. You can see that there are many fees, taxes, and waiting in this case. Now imagine that we were to use a stablecoin like USDC. One Ethereum cost you $500 when you bought it, but it now costs $1,000. You exchange your single Ethereum for 1,000 USDC rather than going to all the trouble, and you simply retain it. A month later, it drops to $250, just like in the prior scenario. Additionally, you exchange your 1,000 USDC for Ethereum. The good news is that you can sell your Ethereum for $2,000 within 5 minutes of it rising to $500 because you traded a so-called decentralized exchange. The fees were less than 1%. But as a result of that, you might swap virtually immediately. Additionally, you believed the USDC because it is just code and doesn't change because it was secure. Unlike Coinbase, Binance, or Gemini, which are under the jurisdiction of the public and, more crucially, the government. They have previously been hacked. That is the aim of stablecoin. But we are veering off subject. You can participate in cryptosphere without really utilizing the bank run by the government. Banks are now taken for granted in many places, including the US. However, some nations have severe restrictions on the amount of money you can travel with or the currency in which you can make purchases. In reality, a bank must inspect and approve every transaction in the United States that is over $10,000. Meanwhile, for just a $5 cost, you may instantly transfer $10 million from one address to another using a stablecoin like USDC. You could never accomplish it using US currency. Lending and borrowing. Lending and borrowing are a crucial component of decentralized finance. In truth, lending and borrowing money plays a major role in the world's current financial predicament. So it stands to reason that the blockchain could perform the task more effectively. We often put down something like 20% collateral, which is one of the reasons we can lend and borrow money from banks with confidence, so that if we don't repay the loan in full, our government can pursue us and imprison us or force us to pay the money. In other words, there are legal repercussions for not repaying a loan. Well, this is a problem with crypto because one of the pros of crypto is anonymity. You could put 20% down and run away with the rest of the loan, never to be seen again. In fact, by using smart contracts, we may give others access to our money, while yet maintaining control over it. Therefore, if you're unaware, smart contracts are just code that performs a specific function. He then receives what are known as C tokens, or tokens, which represent his original coin plus interest. The smart contract is made in such a way that no human being is required to perform the calculation or the transaction. Person A's desire to earn interest by lending conventionality is resolved because everything is automatic. Person B must over-collateralize his debt during the borrowing portion. This implies that he must put up $120 as collateral for a $100 loan. Therefore, the smart contract is constructed in a way that it can pay back the individual their coins plus interest if the borrower flees and never repays the loan. You might be wondering why you would need a loan at this point if you already had the money. Since each Ethereum is worth $100, you're presumably thinking in terms of dollars. For example, suppose you had 10 Ethereum worth $1,000. However, you are reluctant to sell them since you have a strong commitment to the Ethereum project. So you borrow $800 worth of Tether while using them as collateral. The This is a reliable coin anchored to the US dollar. It is now time to repair your debt after trading those $800 around and making some money, losing some money and making some more. You have $850 in Tether as a result, and you return the original $800 loan to obtain your original 10 Ether back. In this small example, though your small trades netted you $50 and you were fortunate, but it has always been a while, and Ethereum soared as it has in recent months. They are now each worth $150. In other words, if you believe in Ethereum and own it, but don't want to sell it and want to use the value of it, you can take a loan out on it in the hopes that it would be worth more when you cash it. Consequently, you now control $1,500 plus the $50 you made trading. However, if you traded, you might have ended up with $750 in Tether after you lost some money, made some money, and then lost some more. You would have two choices. Option A is to put up the additional $50 to pay back the entire loan in order to recover all your collateral, while option B is to keep your $750 while forfeiting your 10 Ethereum, which may be very valuable. This might be too much detail, but a flash loan is a second kind of cryptocurrency loan. This is a loan with a 10-second term. If you could purchase Ethereum on Coinbase for $10 and then sell it on Gemini for $11, theoretically, each time you did that, you could earn $1. Consequently, you can literally borrow millions of dollars using what we refer to as a quick loan. Decentralized exchanges. Most well-known decentralized exchanges or DEXs functions in a way where investors pool their money together and then traders may trade that money. This is a tremendous benefit for anyone who regularly wants to trade their crypto assets. The portion of each trade's charge that is returned to those investors, and nothing changes because everything is written in code. The fees and percentages that you alter are also locked and encoded in code because they can't modify or raise prices to absurd levels like 15%. Decentralized exchanges give users access to a wide range of new tokens and coins. The most well-known decentralized exchange, known as Uniswap, has literally hundreds or even thousands of tokens available for trading. There are billions of dollars locked up in these liquidity pools so that traders can trade. But nobody can control these billions of dollars, which is the decentralized element. Actually, the only people who can withdraw money from the pool are investors. However, if they did that, lending rates would go up, attracting new investors who would then invest more money. Since the code is immutable, it cannot be altered either. We like to say that the code is the law in the cryptography community. It is not under the government's control. The code exists, is accessible to all users, and is static. PancakeSwap is a different exchange on the Binance Smart Chain network that also has a few $billion of liquidity. Uniswap is one of the largest exchanges on the Ethereum network, and it has billions of dollars in its pools. Insurance. The insurance company pays you what the Tesla was worth, so you can go buy a new one. They use statistics to predict how frequently their drivers will crash their cars, and they use this information to predict how much they would have to pay each year to determine what the monthly cost of the insurance should be, also known as the premium. With decentralized finance, the insurance company can be code. For example, if a farmer wanted to purchase crop insurance to ensure that even if his crops failed, he would still receive compensation for planting them and taking the risk, we could write code on the Ethereum network that stated that if any days this summer reached 90 degrees Fahrenheit or higher 4 days in a row, Farmer Joe would receive $100,000. However, to begin this contract, he would need to pay $2,000 so that Farmer Joe could purchase his crop insurance through what is known as smart contract, which is simply code that checks to see if the conditions are satisfied to pay him. At this point, you might be wondering how the code knows it's 95 degrees outside and where $100,000 comes from. To connect the real world to the blockchain, we use oracles, which are reliable sources that serves as a link between the two worlds. Second, the $100,000 comes from other people who purchased insurance and paid the premiums but may not have received payment because the conditions were not met. Just like an insurance company makes money from people who purchase insurance, we can create an oracle in our city that reads the temperature and is verified by a few people to ensure that it cannot be fraudulently used. Then the smart contract can dependably use it as a data source to determine whether insurance requirements are met or not. Margin trading. In essence, margin is a loan that triggers an automated stock sale if the price of your shares drops below your down payment. So you need a $100 loan in order to acquire $100 worth of stock. And if you can provide the bank with a $20 down payment and a tiny annual fee of 5%, they'll agree to grant you that $100 loan. So here are two potential outcomes for the situations when the stock increases from $100 to $150. You decide to sell the stock because you have paper hands and receive $150 in return because the bank already has your first $20 as a down payment. You only have to pay back $80 of your loan. You keep the remaining portion, which is a profit of $70. So you effectively made $70 by just investing $20. Consequently, your financial gains were greater than threefold, even though the stock's insurance was merely 50%. This is how margin has power. You utilize it to multiply your own money when you believe something will appreciate in value. What did you learn about DeFi in the Metaverse from our discussion? Which guide do you think is the most useful? Please let me know by leaving a comment below. And if you enjoyed this video, please press the like button, turn on the notification bell, and subscribe to our channel for more videos like this. Thank you for stopping by to watch. See you in our next video.